There's something very mysterious about IUL policies that has everyone wanting to know more. They offer a unique feature that is unmatched by any other traditional investment. I know when I first learned about this 9 years ago, my mind was blown by all the different ways you can leverage money inside this account. And it all boils down to the ways that you can access money out of your IUL. Now, if you don't know what an IUL is, please pause this video, check out the video that I've linked above that will tell you a little bit more about how it works, because that's important to know before you continue on. But in their simplest form, they are an insurance product that allows a few unique ways that you can get access to your money. You can simply withdraw it, or you can take a loan from it. If you choose to access your money on the form of a withdrawal, we call that the dumb way to access your money because you're actually depleting your account value. Think about it like if you had a stock portfolio and you withdrew money out of that stock portfolio. What happens is you basically depleted the account value, which means you interrupted your ability to earn compound interest. You're earning less interest because you took money out. Now, that doesn't make sense, right? Especially if you have another option. It also is going to make any interest that you earn inside that account taxable to you. And the last thing we want to do is pay more taxes than we have to pay, again, especially if we have another option. And then lastly, the withdrawal means that you do not have the ability to put the money back into your IUL. Let's take a look at an example. Let's say, for example, that you had $100,000 inside of the cash value of your IUL. If you withdrew out 90 grand, you would have $10,000 left inside that account that is growing and is earning interest. Now, if you are, let's say, capped at only $10,000 a year in contributions that you can put into that IUL, well, you can't put all $90,000 back in 1 year because you are capped at what you can contribute in 1 year in an IUL. It's based on the size of the death benefit. So that's really going to be an issue if your goal is to use this account to grow and earn you interest over time, because the withdrawals, again, they are going to make your interest taxable and they are not going to give you the ability to put the money back into the policy when you no longer need that money, right? When you want to replenish it. That's why another way exists called loans. Now you might be thinking, well, why would I want to borrow my own money? Allow me to explain. We call loans the smart way to access your money. And here's why. Loans allow you to get to the money that you contributed. We call that the cost basis, plus any interest that you earned, all tax-free. Think about it like this. The last time you took out a loan to go and buy a car, did the IRS tax you on that loan as though you earned that money as earned income? Nope. How about when you took out a loan to buy a house, or you took out a loan to go to college? Did the IRS tax you on that money? No. Why? Loans are not considered taxable income by the IRS. So what they do is they allow you the ability to get access to money all tax-free. Now here's the caveat to this. In order for something to be considered a loan, the IRS requires interest be charged. So yes, interest does need to be charged to borrow money out of your IUL, but we're going to talk about the different ways that this works. The other cool feature with IULs is there's actually no repayment agreement on the loan. So if you borrow money out to go and buy a car, there's no 5-year, 6-year, 7-year repayment agreement. How it works is if you die with an outstanding loan on your policy, whatever you owe will get deducted from the remaining cash value, and that cash value will get added to your death benefit when you pass away. So your family cannot inherit the money that you borrowed out because it technically is owed back to the insurance company, but that is basically how they get around requiring any sort of repayment agreement. Now, it's also important to know that if you borrow all or most of your money out of your account, there may not be a repayment agreement to it, but you may still be required to put some kind of money into the policy on a monthly basis just to cover the cost to own the policy, because you don't want the policy to ever lapse or cancel. That will defeat the entire purpose of the loan and just make everything taxable, which is a nightmare that you want to avoid. The other great feature is the loan allows you to put the money back into the policy at any specific time you want. So let's take a look at the same example as earlier, where let's say that you had $100,000 in your cash value, you borrowed out $90,000, you're capped at 10 grand for new contributions per year. Well, because you borrowed that $90,000 out in the form of a loan, you can put that $90,000 back at any time you want, at one time, in multiple payment installments, in monthly installments. Any way you want to get it back into your policy, you can return it. And that's just going to help your money and your interest grow and compound faster. Now, when it comes to loans, there are two different loan types that you can access money out on from your IUL. The first one is what we call declared, or you may also know it as a standard loan. This loan type actually removes your money from your cash value account. So similar to like we were talking earlier with your stock portfolio, if you went to take money out of your stock portfolio, you're actually draining it out of the account. It's very similar to how a withdrawal works. The only difference is it's a loan. So that allows you to get to your interest tax-free, and it allows you the ability to put the money back into the policy. But like we mentioned earlier, an interest rate has to be charged in order for it to be considered a loan. So a lot of times what you will see insurance companies offer when it comes to a declared loan is something called a zero wash loan, which means they're going to charge you an interest rate to borrow the money out because they have to, or it wouldn't be considered a loan. But at the end of the year, they're going to recredit that interest rate amount right back into your account. Meaning, for example, let's say they charge you 6% to borrow the money, but at the end of the year, they're going to recredit you that 6% right back into your account. Again, 6 minus 6 is 0, meaning you didn't actually pay anything to borrow the money and to get access to your money tax-free. It's just the way it has to be documented on paper for the IRS to allow it to be considered a loan. So again, if we look at that same example of $100,000, you borrow at 90, you're capped at $10,000 a year. Well, they're not charging you any interest on that $90,000, and you can return it at any time you want. The other way you can access money out in the form of a loan is the unique feature that we talked about in the beginning that is unique just to these types of permanent life insurance policy plans, and it is called a variable, or what we also call a participating or an indexed loan. Yes, insurance companies like to complicate the process and give you multiple names that all mean the same thing. But basically, why this is unique is because you actually have the ability to borrow against your policy cash value. You're not depleting your cash value. What you actually do is you borrow money from the insurance company. Your cash value is used as collateral for that loan and can remain inside of your cash value account, growing and earning interest. Just like if you had a stock portfolio with $5, maybe $10 million in it, and you wanted to borrow money out on what we call margin, you have the ability to borrow against your shares, and the investment company will loan you their money, and in return, allow your money to remain inside your account, growing and earning interest. Now, the only problem with this is if you actually wanted to borrow money out on margin from a stock portfolio, you would have to have literally $5 or $10 million inside your account for them to even consider working with you on that. That feature is definitely not available to middle class America, but everybody can get access to this through IUL policies. Now, again, the only way this works is if the IRS sees that interest is charged, and the insurance company is not going to do a zero wash loan on a variable loan because it's a big risk to the insurance company to offer this feature. So what they do is they're going to charge you maybe 4.5%, maybe 5.5% interest per year to borrow that money out. But if you're earning interest, you might still be making a profit. Let's take a look at an example. Same example from earlier. If you have $100,000 inside of your cash value account and you borrow out 90 grand on a variable loan, your cash value still will show a balance of 100 grand, growing and compounding and earning interest. Now, you might have paid, let's say 5% interest per year to borrow out that 90 grand, but if your 100,000 earned 8%, you paid 5 to borrow out 90, you just netted 3+ positive percent interest on money that doesn't technically exist. It's not yours inside your account. This, my friends, is what we call infinite banking, which is the ability to essentially leverage your money in two places at one time, where it's still growing and it's active inside your policy, and you're borrowing it out to maybe go and finance a project or pay for some real estate or build or expand your business. It's a very unique feature, again, that is not offered in any other traditional type of investment vehicle. And this is made available to anybody that has a policy that has access to variable loans. Now, it's important to note that not all insurance companies offer variable loans because they are definitely a bigger risk to the insurance company. So you always want to make sure that you're working with a carrier that is grade A across the board, been in the business for over 100 years, has hundreds of millions or billions of dollars in assets under management. That's going to let you know that the insurance company that you are choosing to do business with is stable and will be in business long term. Now, just because you're working with a grade A insurance company doesn't mean that's the right company for you. If you're the client or if you're the agent shopping for your client, you want to know what types of loans are available from that insurance company, how quickly you can access money out of the policy, because believe it or not, there are some companies that don't allow you access to variable loans for 3 years, some for 6 years. I work with insurance companies where you have access to that loan type after 1 month, 30 days. So that matters. And also, what are the loan rates? How quickly is the zero wash loan taking effect? What is the interest rate that they're charging for the variable loans? That's all really going to matter and shape which type of company and product is best suited to fit you or your client's goals. And if you're new and you want to learn more about IULs and how they work, I've linked 2 videos here that will walk you through the features of those plans. Make sure you subscribe so you don't miss another day of content around how to properly structure IULs, and I'll catch you next time on YouTube.